Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. What a week it was last week. On Friday, 27th of December, rupee saw an intraday momentum of close to 50 paisa. In the entire 2024, this was the highest single day volatility for the rupee. Despite dollar index was trading in a range, other Asian currencies like Chinese currency was trading in a range, and FII have not sold aggressively. They have sold close to only $500 million. Now let us understand why there was a spike in the volatility in the coming part of the presentation. The answer to that lies in RBI bulletin, which was published few days back. In the RBI bulletin, we were able to understand that between September to October 2024, they have sold close to $35 billion in the forward market. During that time, dollar index, which was trading at 99, went and moved towards 104 kind of a level, and other emerging market currencies also got weaker. So probably in order to defend rupee, RBI must have sold close to $35 billion. Not only they have intervened or sold 35 billions in the forward market, apart from that, they have sold close to $3 billion in the future market. But the question is, they have sold in the month of October, then why rupee got weaker in the month of December? So if you see the table, they generally sell forward contract in tranches. They sell in the near term, then between 1 month to 3 months, and then above 3 months. If you see the data, it is clearly evident that for the month of November, there might be close to $28 billion forward which is getting due. And for between December to January or Feb, there might be some forward contract close to 21 billion which is getting due. Now, on a normal day, if they would have just roll over the existing forward which is getting due in the month of December, then rupee might not have got weaker. So why rupee got weaker? They must have bought the forward contract which was getting due for the month of December, because of which rupee got weaker by 50 paisa. Now what next? One of the main thing what comes into our mind is that volatility will be high in 2025. There are two incidents or two things which are suggesting that volatility is going to spike. First example is on a domestic side. The new governor joined on 9th of December. In next 15-17 days, rupee have got weaker by almost a rupee. And we all know from our history that whenever Donald Trump comes into the market, he likes to create panic and volatility. In 2017, his favorite activity was to just go and tweet in the night, and we will see a reaction next day morning. Now let us discuss outlook on rupee. There can be two scenarios. Scenario number one, up to 5th Jan, markets will have lower volumes as most of the market in the world are closed. Because of that, there is a possibility that rupee can move in a range between 85.20 on the lower side and 85.80 on the higher side. There can be also a possibility that some flows might come next week, and RBI might observe all of the flows, as they might have some forward contracts which are getting due in the month of January. So they might not allow rupee to appreciate beyond 85.20. This is one possibility. Now let us understand the second possibility. Now if you see the chart has given a first indication that there can be a reversal in the dollar rupee pair. Now this is the first indication, and it can only get confirmed if rupee closes below 85.20. If on a given day, if rupee closes below 85.20, then we will suggest exporters to go and increase their hedge ratio, as there is a possibility that the pair might move towards 84-80 kind of levels. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Most of them are taking costing between 85.20 to 85 kind of level. For them, we will suggest that they can cover 80% of their exports between 85.40 to 85.50 kind of levels. For remaining 20%, they should keep a strict stop loss of 85.20. If 85.20 is broken, then they should go and simply hedge. Now let us discuss strategy for thick margin exporters. For last few weeks, we have been suggesting thick margin exporters that they should wait with a stop loss. Earlier, the stop loss was close to 84.80 kind of level. Now, for this week, we will increase the stop loss level from 84.80 to 85.20 kind of level. If 85.20 is broken, then they should increase their hedge ratio. Now let us discuss strategy for importers. Importers who are not covered for next 30 days, they should keep a strict stop loss of 85.80. If 85.80 is broken, then they can go and cover 30% of their import payment which is due for next 30 days. Now on the downside, if rupee comes near 85.20 to 85.30 kind of level, then we will suggest them that they should go and hedge at least 50% of their import payment which is due for next 30 days. Beyond 50%, we will not recommend them at this point of time, because there is a possibility that 85.20 can also be broken and the pair can move back towards 84.80 kind of a level, but it is too early to comment on that. So let us just cover 50%. For next 50%, we will discuss and we will evaluate that on a next week video. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.